Hello, everybody. Welcome back. This is Incubate This, where we talk about how do startups start up. And today we get a lot of questions about funding. What kinds of investment are there out there? When is it appropriate to seek one or another? How do I know if I'm ready? And then how do you find investment capital, from all the different various sources? So we thought it would be good to just take a little time and chat through a little bit of this and see if we can dispel some myths, alleviate some questions, and like that.
And sell a little snake oil.
That's right. That's right. Hey, you know what? Something about snake oil.
You see how many snakes it takes to make a gallon of snake oil?
Where does the oil in a snake come from anyway? Okay. So let's start with talking about the different kinds of capital that are available. Okay. You've probably heard of angel investors. There's actually kind of sub-segments of angel investors. And the very first sub-segment where people generally tend to get early funding is friends and family. And angel rounds have sort of been retermed in the last decade to sort of encompass all of these pieces before an institutional round, which is money from like an investment institution or an investment club. Venture capital typically falls into institutional rounds. Angel round used to mean this like middle segment between friends and family and institutional money. And now angel investment kind of has been retermed to encompass what was typically the angel round, but also friends and family money, early seed capital. All of these things are now kind of synonymous with angel investment. They're not all the same though. When you're thinking about early investment money, remember that the earlier you get money into your company from somewhere else, the more expensive it is. So a lot of times we are partners with Rocky's Venture Club, which is the oldest venture capital club in the country. Actually, I didn't know that. They've been around the longest. Yeah.
Wow.
And they typically work between 15 and 20 deals a year. They get over 1,000 applications a year. And according to Dave Harris, who kind of runs the organization, he says that about 25% of those are just inappropriate for the kinds of things that Rocky's Venture Club invests in. Things like, I want to start a restaurant, or I want to open a bar, or I want to build a heavy construction equipment company. Those kind of things aren't really in the wheelhouse of what they do. And so they have other partners that they kind of refer those people to. But out of 750 remaining applications in various stages of maturity, these guys work 15 to 20 deals a year. That's not very much. They are what you would usually consider like the entry into institutional money. So most companies who get a deal that becomes picked up by RVC have gotten capital from somewhere else first. And usually the very first place you go is friends and family. What does that mean? I go to my dad and borrow $5,000 to what? No. I mean, yeah, it could look like that, but
it's usually a little more formal, right? There's some paperwork.
Yes, exactly. And the way that paperwork looks is there's typically two different kinds of agreements that you might enter into when you're dealing with what we're calling angel funding in a friends and family or a seed capital or an angel funding. And both of these vehicles for the paperwork do not require a valuation on your company. And that's a really important point because if you set a valuation too early and you potentially devalue your company in a way that you shouldn't, because maybe you have more revenue in your first 5 years than you thought, or your first 3 years than you thought, and you've set the value too low. And so now you've given away more equity in your company for less money than you should have. or you overvalue your company. And when you get to a point where you do actually have to set a value and institutional investors come in, well, now the people who invested early are getting a lot less than they thought for the money that they put in. So these two vehicles, which was great, you asked, it was perfect lead in. These two vehicles, one is called a SAFE, and I can never remember what the acronym is.
Something for equity, right?
Yeah, it's a
Simple
agreement for future equity.
That's
Thank
right.
you. I can never remember that. I don't know why. And basically what this is it says, I'm giving you $50,000, $100,000. Sometimes I've seen people do a $500,000 investment on a SAFE, and I don't know what I'm going to get in return for it. I don't know when I'm going to get it. And I'm basically acknowledging I may never see this money again. And if I do see a return on it, it's unlikely to be soon. And I'm not setting any restrictions or terms or minimums about that.
So this person who's giving you $500,000 in a safe
They
either
love
really
you.
believes in your idea
Yeah.
or they gave birth to
Yeah.
you.
Yeah, exactly. Now, what I will say, we have seen companies that are beyond a friends and family round. They've actually, they're working with seed investors, and these are fairly savvy investors who will invest. Bayer is a perfect example of this.
Mhm.
They just had, he's not a friends and family, he's an investor, but he put $500,000 on under a safe.
Yeah.
Now, the other option in this category is called a convertible loan. And I'm going to tell you why an investor in these two options would choose the safe over the convertible loan. But a convertible loan is basically exactly what a safe is. It's saying, I don't know how much equity I'm going to get. I don't know at what point I'm going to see that equity or at what point I might see a return. But this is a loan and you're paying interest on it. Except that there's usually no payment terms. And if the company goes bankrupt, the loan is null and void. So it seems like a convertible loan should be safer than a safe. But it really has the same outcome, except that from an investor's point of view, now I'm paying taxes on interest I'm not actually earning. Because there is an interest schedule and not a vesting schedule,
Repayment schedule.
yeah,
right?
exactly. You're just not actually making any payments against it. So I'm not actually earning the interest.
It's accruing.
Yeah, it's accruing and I'm paying taxes on it as if I earned it.
Right.
So why would somebody pick a safe? That's the only reason why. Because the risk is the same. The valuation question is the same. And on one hand, you have a tax disadvantage, and on the other hand, you don't. So that's why a lot of angel investors, early investors, seed investors, friends and family will do a safe versus a convertible loan.
Why would they? Why would the inverse? Why would they do convertible loan over a safe? Because that actually happens a lot too.
It
I
does
think,
happen.
Like with Techstars, I think a lot of those.
Yes, they are convertible
convertible
loans
loans.
because they are taking a percentage of equity up front.
Oh.
So, and I don't understand all the way that Techstars writes their deals because I've never actually read one or seen one. But I know that there are some other more favorable terms. And for them, remember, the interest is a business write-off.
Mhm.
And they have a lot of expenses related to putting time into companies that they can't get a write-off on. So if they invest into a company and there's actual money they're investing and the taxable interest that they're not really getting, there's a business tax benefit to that that makes it more attractive for them
offsets
to do that. Yes.
Well, that seems to me because the unique nature of their business is this. That is a cost of doing business. Whereas
yes.
if I'm your dad and I give you the money, I can't write off
Nope.
taxes on accrued interest that I owe because I'm an investor
Yeah.
only.
Yeah.
So is
Yeah.
that because that's
Yeah.
their
So
business?
yes. So a safe is typically someone more like your dad or someone who isn't a business entity investing in you. Whereas when a business entity invests, they typically want to see the convertible loan versus the safe because it's the same risk, but they have more benefits to their business from a tax standpoint and a write-off standpoint and a protection standpoint. Does that make sense?
Yeah, in a way, it's actually good for them.
Yeah.
I mean, it is.
Yeah.
Damned accountants.
That's right.
It's like, why can't we just look at what it is? Why do there have to be all these different ways to do it so that you can and then you could feel like you beat the man.
Yeah.
And I think it's a game.
Yeah. It's all a game. It's absolutely a game. The entire tax code is one big game.
It's like that movie.
Which movie?
The Game.
Oh, I love that movie.
I do too.
I love that movie. So that's early capital. And we have seen as little as $50,000 to $200,000 get invested in a company with this early capital before they go after their first round of institutional capital. And we've seen as much as, buyers close to $2 million, all on safes.
Mm-hmm.
Let's talk a little bit about institutional money. Institutional investors, which is where RVC typically falls, is usually when a business entity of some kind, and we would call this, I'm using quotes on purpose, smart money, because these are people who do a lot of investing in risky, higher risk than normal stock market, FDIC insured, bonded stocks and bonds and things like that. So these are people who understand the risk of what they're doing. A lot of times, like in RVC, you get anywhere from 15 to 30 investors that pool together to come up with the total raise that a company's looking for. And there's less risk than the pre-valuation. So we can kind of say angel, seed, family, friends money kind of comes pre-valuation. Institutional money is when you have to set a valuation on your company. Why do you have to do that? Because no institution is going to invest in something without understanding what they're getting out of it. Okay. So your dad is like giving you 50 grand.
He doesn't have to justify that to anybody.
He doesn't. RVC, they have to justify, we're raising $500,000 for ABC company that pitched this product or service or whatever that they want to put out in the market. And enough people got behind it that we raised the $500,000. What are we getting in return? If you have a valuation of $10 million on your company, then you know that $500,000 that you just raised is worth 5%. And so in exchange for giving you that $500,000, we are taking 5% equity in your company. Now, does that mean that I necessarily have $500,000 worth of value in your company?
No, it's just math.
Yeah, it's a
different unit of measurement.
Yes.
A share to a dollar.
Exactly.
It's just it's a currency conversion.
Exactly. Daryl and I went to an RVC meeting. The last Tuesday of every month, RVC, Rocky's Venture Club, does a mastermind meeting where they have entrepreneurs, all different realms of business, different levels. Some people have been selling in the market. Some people are still in the idea phase. Some people are getting ready to go after capital and they know nothing. And they all get together and talk. And Dave is an amazing resource for that meeting because he's the head of RVC. He answers these questions just with amazing insight and knowledge. One of the groups, one of the companies, he had two guys there, the CEO and the CTO from their company, and they had this idea for this game. And I won't go into all the details of the game. They were like, we're getting ready to have discussions with institutional investors. How do we value our company? How do you come up with a valuation? And I love the way that Dave Harris kind of talked about all the different things that you might do. And then I looked at him and I said, yeah, but really it's just throw spaghetti at the wall and see what sticks. And he was like, yeah, you kind of got to go into a meeting with a number in your head, look at the market of apps or technology that's similar to yours in that geographical region and where are they valued at, pick a number, go into a meeting and see what happens. Because if an institutional investor sitting across the table from you says $5.5 million, that's crazy. Maybe 3. Then the next meeting you go into, you're like, we were thinking about $3.5 million. And then he's like, okay. It is literally that unscientific. And what's crazy is you can actually pay $20,000, $30,000, $40,000 to valuation firms, and they will give you a number
that may not be acceptable to your investors, right? They may go, oh, that's way too low, or that's way too high.
Or that's way too high.
And it's not based on anything more than your spaghetti.
It's based on which way is the wind blowing today? Oh, these people have all been in the 3 to 4 million range. Okay, I'm just going to sit right in the middle of it. Oh, but 6 months later, if we're looking at the valuations, like, whoa, everybody's getting like 6 million now.
Oh, that's interesting. Your value isn't really your value. Your value is relative.
Yeah. Until you have a stock that you can sell on a public exchange and you know, because something is worth what someone will pay for it, right? That's the ultimate end goal. But until you have that objective medium by which to define a value, it's literally like, what fish am I swimming near today?
And that's what an investment is.
In the ground first.
Yeah.
That's just putting a stake in the ground. And somebody may say you put it in the wrong place.
Yeah. And you go, okay, we got to move our stake.
But
that's what an investment is. It's someone coming to you and saying, I'm willing to pay this much for your company.
Yes.
Or in this case, I'm willing to pay this much for this percentage of your company.
Right. Right.
And suddenly that stake has been put in the ground.
That's right. And a lot of times what you'll see happen is, these companies, they'll have raised however much in seed funding and angel funding and whatever, and they'll go for their first institutional round. And they'll say, we're setting the value at $10 million. We need to raise $500,000. That's going to get us through, that gets us 12 months of operating. Here's, what we're buying with that money over the next 12 months. And a lot of times investors will go, this isn't worth 10 million.
Yeah.
Maybe 5, which is why we say the earlier you get capital, the more expensive it is. Because remember, you have all those safes and convertible loans that are just sitting there waiting for you to set a value.
And that value is not just an esteem issue. If we look at that currency conversion, that's kind of the key here. Going back to that, if they've given you $500,000 investment against 10 million value, that's 5%. Well, if you valued your company at 50 million, it's only 1% of the company they own.
Exactly.
The company will be worth something that's much more objective at some point once people actually start trading or buying or like you said, the market
revenue to show.
Yeah, the market puts a value on it, but until then, it's a speculative value. And if you say, the company's worth 50 million, then my $500,000 only gets me 1% of what that future real value is. So as an investor, I'm trying to invest the fewest dollars to get the highest percentage
right
of value. And since it's dollar to dollar in the value.
Contrast that with the entrepreneur is trying to get the most dollars they can and give away as little as possible.
Our company is worth $1 billion.
Exactly. So all of this to say, the earlier you get capital, the more expensive that capital is because you have no value. And when you set that valuation, the best thing is the thing that I tell every entrepreneur, the best thing you can do before you go after institutional money is get sales, because real sales translates to better valuation than we're projecting this. Well, show me.
Many companies are bought and sold. The price is set based on a
revenue,
a times sales number.
Yep. It used to be in the early world of SaaS, you could get a 20x on whatever your annual revenue over the previous 2 to 5 years was.
Which means when you sold your company, they were going to pay you 20 times what your annual revenue was.
Yes. We've seen that number shift a little bit because of the nature of the SaaS marketplace and 3-sided marketplace, like all these different distinctions. It's trending right now to more like between 5 and 10x. It seems like the 20x sort of diminished. That's set at a much different premium and a much different level of company now.
Yeah, it's just not worth it anymore.
Yeah.
It's just not start company.
Yeah.
You can't get
5x.
But to that point, so let's say in the previous 18 months, you posted $1 million in revenue. That's a lot more valuable than somebody who says we were projecting $1 million in revenue over the next 18 months.
That makes sense. A buck in the bank is worth a lot more than a number in a spreadsheet.
That's right. That's right.
And when the potential investor comes to you and says, what makes you think that this company is worth whatever, you can go, well, all of these sales are what makes me think that.
Yeah. Yeah.
Silkroad.com. sure he had lots of sales.
So when should you go after investment capital?
In the morning.
Yeah, in the morning. But with coffee, What I tell people is a really good rule of thumb. It is much cheaper to borrow on consumer debt. I'm talking credit card advances. I'm talking second mortgage on your house. I'm talking putting a loan on your car, an unsecured line of credit. Even with those interest rates, it is much cheaper to borrow that way to invest in your idea and essentially bootstrap it on interest than to give away parts of your company too soon.
Okay, so I have a question.
Especially if the number is less than 100,000.
So why then wouldn't you just as a new business owner, why wouldn't you just do like they did in the old days and just go to the bank and get a business loan?
You absolutely can. And that's a great option, especially under that $100,000 line.
Because you're not giving any company away.
You're not giving any equity away. Now
and if you've got sales, you might have the money coming in to make the payment.
And you are personally guaranteeing that loan. That's the bank's going to look at your credit worthiness. They're going to look at your ability to repay your other obligations, et cetera. But if you believe enough in yourself and your idea to get yourself to that place where you have real sales, you've created more value in your company and you've done it without giving anything away. And you've proven to yourself and to other people, you have a market.
Yeah. Well, and that makes you a much more attractive purchase later on because you can say, I'm all yours, baby.
Yes. And
there's nobody with any dibs.
And execution's everything. So you've said, I'm going to take the risk to prove that I can execute on the first however much of my business plan. And once you've done that, investors go, ooh, that's super attractive because you show chutzpah, stick-to-itiveness. You weren't afraid to take the risk yourself and you got something done that produced some sales.
Mm-hmm.
It doesn't even have to be a lot. It just needs to prove the model works, to prove that there is real money that can be made.
What kind of startups are institutional investors looking for? I mean,
it's a great question.
Kind of to your earlier point, RVC is not looking for restaurants and they're not looking for bars.
No.
So what are they looking for?
That does though.
Yeah.
Well, I'm sure there are some investors that are, especially if you're kind of like a high-end, trendy club, bar, restaurant, whatever. There's
definitely groups that are specialized in different areas
because they have industry knowledge, but they all have backgrounds in running restaurants and they're probably the hospitality industry, right?
Yes.
So the answer is there are different types of investors for different types of companies.
Exactly.
RVC is probably trending more towards technology companies, I would imagine.
Yeah, financial technology, healthcare technology.
What about, because we're in Colorado, microbrews? Have they invested in any kind of brewery type places?
No,
or what about dispensary type or cannabis industry?
They haven't crossed that yet either. But they are investing in a lot of like outdoor companies and lifestyle companies.
So they get more into recreation.
Yeah. I would imagine that CBD or marijuana or something, they're going to go there, but not till it's federally legal. Because remember, not everybody in RVC investor
is still
and the
restricted.
banking. Yes. There are venture capitalists, angel capital investors, seed investors, larger institutional investors beyond capital. When you get to Series A, Series B, all different kinds of organizations that would invest in all different kinds of companies. And you want to find ones that are experts in what you do.
Yeah.
Because they're going to be the
resources.
Yeah, exactly. You want investors that are not just putting money into your company. They're knowledgeable about what you're doing and they bring something to the table.
That's a really important point we didn't talk about was, it's all sounds like you're looking for investment money and walking around with hat in hand and you'll take it from anybody. But that's a good point to pick and choose who you're hooking up with. This is a relationship.
Yes.
And there are some really bad investors out there who will take advantage of you. And you start
controlling the company.
If you have investors that aren't savvy, you can get a skewed view of what you're trying to do.
You can get them hounding you like, why isn't this? Why isn't this? Why isn't this?
Yeah.
You're like, that's the way the business,
Yeah.
Chill, bruh.
Whereas if you get an investor who is knowledgeable about what you're doing, sometimes you can go to them and say, okay, something's missing. Like you get a bigger advisory group. You know what I mean? And people are the absolute most important thing when you're doing an investment. The one thing I say, and I put this in one of my therapy McNuggets, startup therapy couch McNuggets a while back.
That's the official name.
Probably can't call it McNugget. Yeah.
I was thinking of the McDowell's thing.
I was going to say it's Mac Nugget, not McNugget.
Mac Nugget.
Mac Nugget.
Because of Macs, yes.
Yeah.
Right.
So one of the things I put on the startup therapy couch one week was don't skip over your team in your pitch, because it is actually the most important thing. Teams and people are what it takes to execute on ideas. Don't blow by that. Put good people who know what they're doing, who are knowledgeable in your industry. So for example, there's a guy here in Denver that did a pitch to the golden chapter of RVC 2 months ago. It's an outdoor company providing access to experiences that are provided by small mom and pop companies in ski areas that you may never find them because they don't have their own website or they're tiny and they get lost in all the traffic of Alterra and Vail Resorts and blah, blah, blah. One of the guys on his board is Bodie Miller. He's an Olympic skier. And because he was the guy who started the company, was the CEO, was a ski instructor through various channels. He got a chance to have a conversation with Bodie Miller. Bodie Miller said, this is brilliant. I want to invest and I want to be on your board of directors. That is a huge win for that guy. You don't blow by that in your pitch.
Right.
Well, that's how Elizabeth Holmes did what she did. That's really
exactly
is the
how
key.
She did it.
Was that list of names that she had on our board.
Yep.
So who invests with you is not a private thing. You're going to want to be able to drop that in front of people like, I've already got money from these. Well, like our client Pup Tech, who got an investor named Nick White, who has a show on the Pet Channel and is like the canine trainer to the stars. And he has a Wikipedia page. We like to let everybody know that this guy has invested with our client. Because, oh, really? Well, maybe I should get in on that.
Yeah.
Right?
Yeah. And because Nick White owns the largest dog training franchise in the United States, there's not only does he bring money, he's one of the biggest customers so far.
And he brings customers, yeah.
Yeah. And he understands the problem that William's trying to solve. So when William puts something out there and asks Nick to give his feedback, that's valuable expert feedback.
Right on.
Right on.
So why wouldn't I just go find a Medici and just tell them to give me some money?
I don't know what that is.
The Medicis, they were
the rich
you want
Italian
to find
patrons.
They were patrons back in the day, right?
Like
you didn't have
Queen,
investors. You had patrons, benefactors who would give you money.
And that's how Columbus made it to America, right?
Or whatever.
Yeah.
Or Queen Isabella?
Yeah.
Isabella, I don't remember. But yeah, they were the rich benefactors to Columbus.
This is our
who paid for his trip
trivia
to
podcast.
The New World. Yeah.
Nina Pinta.
Santa Maria.
Hey, if you can find a benefactor, you should do that.
Yeah.
Like, no doubt.
I want to get a shirt. Will you be my benefactor?
Benefactor.
Who's your benefactor? Any idea how many deals a typical venture capitalist firm will do in a year?
Rocky's Venture Club's pretty typical.
Is it?
Between
Okay.
15 and 20, because the amount of work you have to go through to get institutional money, due diligence, all of the financial reviews, all the pro formas, all the steps you have to go through, they're intensive.
Yeah.
And that's why oftentimes like RVC uses lead investors, sometimes just one on a project, but usually 2, maybe 3, who shepherd companies and projects through the process to get to the point where people are like, okay, yeah, we're writing a check.
At that level, how much is this going to cost you as a company just in legal to get that done?
Yeah, it's a really good question. Attorney's fees are the most expensive thing outside of like salaried labor in a startup. And you shouldn't skimp on it.
Yeah.
I mean, it's hard. I can't give you a number.
Right.
Yeah, but
I
you
guess
shouldn't
I
skimp
was
on it.
asking a question to make a point.
Yeah.
That's going to be
it's a
big
huge
cost.
expense.
Yeah.
Outside of your labor costs, that's going to be your biggest. And it should be, because if you're promising equity value, you want to make sure that the terms are not more favorable to your investor in ways that make it so that you lose control of your company or you're cut out altogether.
Yeah.
You know?
All really anybody cares about in all that stuff is no surprises.
Yes.
Mm-hmm.
That
Yeah.
it will work out the way we're saying it's going to work out.
I compare
And
it
that's
to
so sad that we can't just, have a piece of paper that says, this will be the way we say it is going to be.
Yeah. I compare it to a prenuptial agreement. So this is a document that says, we're getting married because right now we think that's a good idea and we love each other. If at some point in the future things go sideways, here's how we're agreeing when we're being civil to treat each other. That's all it is. So none of these agreements are designed for the company that hits it huge and every investor is super stoked. They're all designed for what happens if it goes bankrupt in 5 years or the idea never takes off, or so that people feel like
What's
we
my
can part.
downside?
Yeah. We've spelled it out
What's
so we
the
can
max
part
loss?
friends. We can part with no love lost between us.
Because when it happens, it could start to hurt, but then you say, well, this is what we agreed to.
Yeah. This
And
is
so
what we knew was a
keeping my
possibility.
word.
Yeah.
And I think that tends to work fairly well. My impression of Silicon Valley is in situations like that, you do a startup, you get institutional investment, you get $2 million, whatever.
Yep.
You do your company, whatever it is, and it just doesn't work.
Yeah.
And it fails, and you close the doors, and your investors have lost $2 million. Oftentimes, those same investors want to invest in your next company,
Yeah.
right? Because to their mind, it's like, okay, you know now what not to do.
Yeah.
You felt the sting of that pain.
Yeah.
And you're going to really push to make something out of this next round of funding that we're going to give you for this next idea.
Yes. Exactly.
So their way of thinking is not a bad thing at all.
Which sounds funny, doesn't it?
It does.
If I come to you, and it probably doesn't work with family and friends as much.
No.
Because if I invested the money with you and you, I'm not going to do that again.
Right.
Fool me twice.
Yeah.
But with the institutional, as Daryl says, that's a really different attitude
Whole
because
different.
they look at it as like, you got some street cred. You've got, you went
got
through
some
the
bruises.
hassles and you know like
what's coming and you're still willing.
And like what Daryl said, mistakes. You see some of the mistakes that you made that you won't do now.
Yep.
And that's one of, I think, the sort of shining aspects of our industry to that end is we do embrace that failure. I think that's one of the reasons why it works in this country. And
Got no choice.
A lot of choice, yeah.
fail.
Right.
Sorry.
But compared to a lot of other countries where you can't do that,
Yeah.
it's not legal to do that. And in
Yeah.
our country, it's like, yeah, go do it.
Yeah.
Go make these mistakes. Go fail.
That's right. That's right. As long as everybody goes in eyes wide open,
Go make new Coke.
it will
Open
suck,
Cola.
and
Do you
no
guys
one will
remember
eat
Open
it.
Cola? It was an
No.
open source cola, open source Coke competitor. Yeah, it didn't go very far.
Ew.
This was- this was-
everybody's checking
What?
stuff in.
Right.
It's gross.
This was during the .com boom,
And
where
subsequent
you had
bust.
blues and beans.
Last thoughts. If as much as you can, especially with something that is largely web mobile app based where your product is code, bootstrap as much as you can. Get something tested out in the market, spend a little bit, $10,000 to $30,000 and spend it all on marketing and social media and get as far as you can so that you can prove to yourself and to potential investors and whatever that there's really something there, because you'll give away less and it will cost you less. Bootstrap, bootstrap, bootstrap. It's one of the reasons why in our incubator, we don't generally tend to invest in hardware companies very much. We love software companies because it's our time and that's what that's what our biggest investment is. But we know how easy it is to change code if we get it wrong or tweak something if the market's telling us, we just need to go 1 degree this way and wow, the whole market opens up. Versus with a hardware device.
I got to send 30,000 units into a trash can because
Yeah. And there's, $5 a unit, that's $150,000 mistake.
Mhm.
And depending on what level of production you're at, there may not be anything you can do to fix it.
Yeah.
And you may, depending on how good your attorneys were that you paid all that money for, you may or may not have warranties or recourse about that either.
Right.
So
Which, by the way, is not a real world example, is not something that PubTech has had to do. We're not having to throw away 30,000 units. We haven't even made 30,000 units.
No. And PubTech has done all the right things because one of the guys on the advisory board has built hardware products and on the board of directors with me. He's built products like this. So when William's like, well, we're getting this cost or on this chip, and Seth is like, wait a second, that doesn't sound right. Like, let's talk to more people.
Yeah.
And so he can tell him what's valid and what's reasonable and what's not, and how do we, he can help guide. Right. So again, and Seth has also invested. So he's not just on the board of directors, he's also invested. So again, smart investment, smart money, people who know your industry, people who can help you avoid some mistakes and who will understand the ones that couldn't have been avoided. All right. Anything else?
Yeah, I think for me, this was real informative. And, I've always thought about this whole topic is if it were me looking for that money, I would be so focused on who likes me the most, who can I convince the easiest, who has the most money.
Yeah.
But we've brought up a lot of other issues of this is somebody that I'm getting in a relationship with, and there's a lot more that I need to get from here. And to not forget that, what am I worth? But don't go to that person and say, oh, well, my company's only worth $1 million, so you can get 10% with $100,000.
Yeah.
Because then when the company goes through the roof,
you gave away a lot.
Turning over 10% of what that company's worth. So, remember your value and look for all those other factors that we're talking about.
Awesome. Anything?
This is like, back in my young boy days when I thought I was going to be a famous musician who couldn't play any music very well at all. The big thing back then especially was getting a label to sign you.
Yeah.
Right? And you have arrived once you've been signed by a label. When in fact the reality was now it's getting real. Now you're just getting started. Now the hard work starts, right? And I think there's a similar analogy here where people think, oh, I got VC funding. Now I've arrived. No, now you got people who have money in your company and they expect results.
Yeah.
But I think it's okay to say,
you've never been in
go
the
get
private
yourself
sector.
a large start, go get yourself a large coffee and enjoy it. It is validation.
It is validation for sure, 100%.
And it tells you you're going to be able to start taking the next
But that's
steps.
not the goal. I think there's a lot of companies out there that think the goal is to get that venture capitalist funding. Well, no, that's just an instrument to help you achieve your goal.
Yeah, which is build a company.
It's only a goal if you plan on skipping out at that point, right?
Yeah. So the last piece.
No, we shouldn't talk.
I'm going to have to beep that.
The last piece that I would say is don't be too quick in your pitch to investors to talk about your exit. Some investors get it. They're like, yeah, you want to build something and in 5 to 7 years you want to be acquired and you want to move on to the next thing. Mostly what investors hear is they're going to own a percentage of a company that no longer has you at the helm. And if we remember that people are the most important thing and you're saying you're going to be going away, what am I investing in? Like, I don't know who you're going to sell it to. And am I going to want to be part of that? So be cautious about having an exit be your end goal and talk about how you're going to build the company. Talk about how you're going to create value for people. Talk about how you're going to solve the problem. Every investor wants an exit, but we don't want you talking about it all the time.
Yeah.
It just makes us nervous. All right. So for Grant, Daryl, and Cynthia,
you got it right.
This has been GotAnAppIdea.com sponsored Incubate This. And we look forward to seeing you guys next time. If you weren't aware, we do put these on YouTube in video format. And we also have these in a podcast format published by most of the major aggregators. But if your favorite aggregator doesn't have Incubate This, let us know and we'll get it published. So we'll see you guys next time.